Welcome back to CFI, or Credit, Finance, and Investing. In this short video, we're going to discuss credit scores, what they are and why they matter. Now, in this video, we are not going to discuss how to build credit. That's something that we'll address in a different video. But as far as a credit score goes, what is it? Well, a credit score, for those who don't know already, is essentially a report card on your credit. It tells people who may be willing to invest in you or lend you money or lend you an apartment for rent. It lets them know how you have historically repaid other people that you have obligations to. If you have repaid people on time, your credit score is higher. If you have collections or if you have not paid people as agreed, meaning typically more than 30 days late, then your credit score is lower. As far as why credit scores matter, credit scores have a dramatic impact on people's lives, and it typically means how much you pay for financial services. If you have a lower credit score, you pay more. If you have a higher credit score, you pay less, traditionally. So a few different places in your life that would use a credit score. Number one would be a bank. Anytime you go to open a bank account, banks will require your social security number, and they will use that in part to find out how your credit is. Now, when they pull your credit or check your credit, it's not a hard pull as some people would expect, meaning a hard pull is you're inquiring the credit bureaus for a loan, and that the credit inquiry is what it's called, can affect your credit score. With a bank or with other soft pulls, it will not affect your credit score. The banks then want to know, have you paid people back, or have you had a lot of collections? What they're worried about is typically, are you going to have overdraft fees, which then require more work and money on their side? Or are you in a situation where there may be garnishments out of your account, where creditors have come after you and they will require, again, work on the bank's part to track your money and give it to a third party. Another area where credit scores are commonly used are renting apartments. Anytime you rent an apartment, the majority of landlords, whether it's a property manager or a private individual, they will pull a credit report to determine if you have a higher likelihood of repaying them or paying them rent on time. If they see multiple collections, especially if they see utility collections or things that are not paid on time, they will utilize that to make their decision, and they are allowed to make their decision based on your likelihood to pay. Other areas are insurance companies. Years ago, when they first started using credit scores with insurance policies like auto policies, I was talking to an industry insurance executive, and he informed me that there were studies that showed a direct correlation between someone's credit score and their likelihood to be in an accident. That was surprising, to say at the least, but since that time, more and more companies have required credit pulls as part of obtaining an insurance policy. And then the final one that we'll touch on today, and this is probably the most commonly known use of credit scores, is getting loans and credit cards. And again, just like most other things, the higher your credit score is, the lower your interest rate is likely to be, and the more money someone is willing to loan you. If you have a lower credit score, you may be denied credit altogether, or you may be charged a much higher interest rate to offset the risk of lending money to someone. So let's look at credit scores a little bit more fully. And in this slide, this is from a site from LA Times, and it talks about how credit scores work, and it's called a FICO score here. Now, FICO is the company that created the model for credit scores. It's Fair Isaac and Company. And we see here that credit scores can range from 300 to 850. Now, I have looked when I was in the finance industry at thousands and thousands of credit reports, and the majority of credit scores that we ever saw were between 500 and probably about 820 to 840. Very rarely would we see credit scores below 500. We would see them, and even more rarely, I think out of all the credit reports I've looked at, I've seen two that were under 400. So the majority of people that we would see would be between 500 and probably 820 to 840. And the legend over here shows you the ranges. Between 300 and 580 is usually poor. If you're less than 500, most people will not give you credit at all. Between 580 and 670 is considered fair. 670 and 740 good. 740 to 800 is very good, and 800 to 850 is considered exceptional. What I can tell you also, again from my experience, is during good economic times, there's some wiggle room here where people may be willing to give credit where normally 600 would be a cutoff or 640 would be a cutoff. They'll drop that requirement down to 620 in good economic times. As economic times tighten up, or in times where we see bank failures or other issues like that, credit requirements will tighten up. So the economic times will make a difference. Accordingly, you will also see people given higher credit balances on credit cards in good economic times versus tough economic times. Moving on, let's talk about how people fit within the credit sphere. So generally, this is an older slide from Credit Karma, and I want to say this is probably about 5 or 6 years old, but it's still fairly accurate. You'll see this change a little bit again as people's credit improves or decreases. So what this is talking about is the percentage of the American population or the United States population that fits within different tiers. Within the 750 to 850 credit score tier, about 10.4% of the American population fit. 12.7% of the American population fit between the 700 and 749 range, 21.8% fit between the 640 and 699 range, 25.4% between the 580 and 639, and 29.7% between the 300 and 579. Now, I really wish they would have broken this out a little bit more, say above 500 to 579, because my gut feeling is that the majority of this tier are 500 plus or 500 and greater. So you can see the majority of people are between 580 and 850 according to this range from Credit Karma. Now, what does that mean? Well, that means that if you are on the low end, you're very below average and you might want to work on getting it up. And if you're up here in the 700 to 750 or 850 range, congratulations, you're doing a good job, especially if you're in the 750 to 850 range. If you have good credit and you have a good income and you have the other financial pieces that people are looking at, then you'll be able to get the loans and things that you're looking for in a much less expensive model. Now, this graph shows which generation fits within which category. And I'm only bringing this up for a specific reason that I'll mention here in a second, but it talks about the silent generation being 760 on average, the boomers being 742 on average, Gen X 706, Millennials 687, and Gen Z 679. This is about what we would expect because the silent generation and boomers have had much longer to acquire wealth and to acquire credit in general than Gen Z. So Gen Z, this doesn't mean that they're a bunch of deadbeats and not paying their bills. What it means is they're just getting established. Just like millennials, you can see that everyone's improving over the course of time, and we would expect a chart to look like this. When we look at the average credit scores or the credit score distribution, it's also important to see how it flows with economic times. This chart is old. It's from 2017, or the latest data is from 2017. But it shows 4 time frames, 2007, 2009, 2013, and 2017. And it shows how people's credit fared, or which of the buckets people fit into the most during those times. So you can see that here in the 300 to 499 range, again, this is where very, very few people fall typically, and it's even less than 5, it's around 5 to 7 or 8%. In the 2007 timeframe, when the economy was very good, about 7% of people were there. In the 2009 timeframe, which would be in the middle of the Great Recession, it only slightly increased in this bucket. And then in 2013, as the economy recovered, more people were out of this bucket, and in 2017 that was when the fewest people were out in this bucket, and they had moved into these other categories. So let's take a look over here at the 800 to 850 time frame. You can see in 2007, when the economy was really good, they stayed fairly consistent with 2009 when the economy was really bad, but then as the economy continued to improve in 2017, things got a lot better and people's credit scores improved, or the number of people within this credit tier improved fairly significantly. The next thing I wanted to look at was what is the average FICO score in the United States? And if you look at this chart from CNBC, it shows that in the beginning of 2006, again when the economy was starting to take off prior to the Great Recession, the average credit score was 688. However, when we're looking now at 2020, or I'm sorry, not now, but in 2022, the average credit score had climbed to 716. You can see that it did dip as we went through the Great Recession and as we came out of that in 2010 being 686 at the lowest. And then it continually improved as the economy improved. I would expect if the U.S. economy goes into some sort of a recession or in significant financial distress, you would expect to see the 716 average credit score go down accordingly. Now, enough of the stats. Let's talk about how credit scores are completed, or how credit scores are generated. This score from my FICO website talks about different makeups of a credit score or of a FICO score. You'll see that some things are minor and some things have a higher weighting. So for example, new credit only gets a 10% weighting. The length of a credit history is 15%. The credit mix, meaning the different types of loans, whether you have credit cards, car loans, home loans, collections, liens, other things like that, weighs 10%. The amount owed on those makes up 30%, and the biggest piece is the payment history. Now, this makes sense because the way you pay someone back and the amount that you owe really determine how you will pay someone back who gives you a similar loan. If you're going in for a mortgage loan and you're buying a similar sized house with a similar sized loan, someone can look at your existing loan and say, well, they've paid over time already. There's a high likelihood that they will continue paying, especially if the amount owed is similar. New credit, because it doesn't have a history of being paid, gets very little weighting other than, did you take on more debt? If you took on more debt, that can make you at higher credit risk because your payments just went up. The length of the credit history is important because we want to see how long someone has had credit in general. Now, this may be very well one of the factors that the boomers and the silent generation have over Gen Z, because they've obviously had a length of a credit history much longer than someone who is just getting it. And the credit mix also does matter because someone with multiple credit cards has the ability to take out more debt, whereas someone with fixed loans, meaning a home loan or a car loan, has the ability only to continue paying on those debts and not incur additional debt. So this is how people look, or this is how the creditors will typically look at your credit overall as determined by the credit score. So when you're getting credit, it's important to make sure that you also monitor your credit. That allows you to learn a few different things. Number one, it lets you know if someone has hijacked your credit or if you've been a victim of credit fraud, and then you can take steps to rectify that. You can also make sure that it is accurately showing if you have paid on time or not. We have seen situations where someone had an open credit card with a zero balance and was not aware that an annual fee was charged, and that annual fee then got charged. And of course, they didn't think they had any payments on it, so it rolled into a late payment scenario and hurt their credit scores. So keeping an eye on that is very important. Also, you want to make sure that the balancers are about accurate, but the final thing that you want to look at in your credit report, or a final thing at least, is do you have any collections or liens that you are not aware of? All of that shows up on a credit report and can hurt your ability to get new credit if you need it. It can hurt your ability to get the apartment you may want or to buy a home if that's what you're looking for. So how do you get a copy of your credit report? Well, every year, every citizen of the United States is able to get a free credit report at the website annualcreditreport.com. You can come to this site, click on request your free credit report, and follow the steps to sign it up. That's it for today's video. Thank you for being here. If you have any questions, please put them down in the comment section below. If this video has been of value to you, please like and subscribe and share with others. Thanks again.